Hi, this is Brad Olson with Oaktree Financial Services. I'd like to welcome everybody to our third quarter report, basically highlighting some of the economic numbers, a little bit what's going on in the economy and how it affects your overall portfolio and our planning as we go forward. As everyone's well aware, it's been a fairly volatile time with a lot of information flowing out from various sources that we need to try to digest and figure out what is the best path going forward as we're allocating the assets. It's a very dynamic world right now, and it's something that we need to take a look at. So thank you for joining us for the update. We're going to talk a little bit about where we're at in the business cycle, and then the key is how it affects into your goals and risk tolerance and how we're going to set up your overall asset allocation. So first of all, as we go forward, let's take a little look at what we're going to cover overall when we look at some of the key items and get to the next slide here. What we'll cover is overall market performance, inflation concerns, the economy sliding downward, or are we stabilized? Are we going upwards? How are we positioning our portfolios going forward? Now, if you have any questions, feel free to submit them through the Q&A part of the Zoom call. We'll take those questions at the end and answer them. So we really appreciate it when people have input. So feel free to do that as we go forward. Now, just to let you know, we are recording this event, and if you don't want to be recorded, if you were to ask one of your questions, and you're asking that through a written format, so you won't actually be on the screen, but we do have to let you know that this is being recorded. We use it for training and educational purposes. Actually, we do post this on our website, and actually we do post it on YouTube to have it made available for people who want to watch it after the fact and go through it. As we look forward, we always want to let you know at Oaktree Financial Services, throughout the COVID experience that we've had for the last year and a half or so, really we've been focused on continuing to do business as much as usual as possible. We do want to let you know, if you do come into the office, we do respect whatever wishes you have on how you'd like to conduct the meeting. We have been doing a lot of Zoom meetings, so feel free to contact us, and we'll set up the best way that you feel comfortable in getting together, either again over more of an electronic way or in an in-person way. So it's we're very flexible that way and want to respect whatever your wishes are. It shows here we're in Bishop's Court in Bishop's Woods in Brookfield. Very easy to get to, so always feel free to give us a call and stop in. So come visit us at any time. We are going to have a poll that's going to be available to you that we'd like your input on. One of the things that we're always curious is we're looking at retirement planning and just planning overall. What is the one thing that worries you most about your retirement? When you're getting ready to retire or you're in retirement, what is the number one concern you have? So feel free to go down to the poll in the Zoom call and fill out that poll. And there's going to be 3 choices you have as far as answers. And pick the one that you feel is most pertinent to your situation. Okay, next, briefly want to talk a little bit about what the agenda is going to be. But before we do that, just a couple of highlights of what's going on at Oaktree. Some things we've got going for the fall of 2021. We continue to update our web that we have. If you want to get onto our website, feel free to do that, because what you're going to find is you're going to find that there's a lot of information there. Every basically 2 to 3 weeks, I'll go through and I'll do an economic update. Here actually is a picture of that for the people that are looking and not just looking at the screen if you're seeing me. We do have that available to you. So feel free to do and go in and look at that because it really gives kind of our thoughts on where the economies are. One of the things for people who have IRAs, we've taken care of most of those. And if you we haven't done it yet, we're looking through all those to make sure that we're contacting you to see when we want to take that RMD, if we haven't done it, whether you want to do a charitable direct contribution with your RMD. These are some things that we're very actively looking at. Also, we're always making sure we're updating your trusted contact information. We have been doing some seminars, some on Social Security. We're actually looking at doing one on Medicare. We have a lot of questions from both people who have to make a decision on Medicare or are making decisions on how to renew their Medicare supplement policies. We're putting together some information on that and bringing some expertise in on that. We have ongoing communications that are out there to you, so you can get as far as the quarterly update, We have emails that are going out. We have communications on different subjects. So feel free to utilize those, and we would love your input on what you're seeing and if you'd like to see anything different. So feel free to let us know. Let me flip forward here. So first of all, in part one, we're going to take a look at, sure my slides going through. Now we'll start looking at kind of a recap of what's going on in the economy, what's happened a little bit in the third quarter and what we're talking about in the fourth quarter. Before we do that, first of all, let's look a little bit in the rearview mirror of what happened in the third quarter. You can see some of the averages on a year-to-date basis, on a one-year basis. I'm not going to go through these. You can see these on the slide. You can see so far, if you go back year-to-date, it's been a pretty solid year in the markets. Which honestly, going into the year, we weren't expecting quite this strong of a year, but the recovery continues to come out of COVID. So that has been strong. So we've basically been overcoming some of the whole COVID Delta situation. Even though it has slowed economic expansion, we have seen that we've taken steps to do some work on that. Now, what happened in the third quarter, if you look at quarter three, you can see that the S&P was down, or basically about even. The Dow was down, the NASDAQ was down. What happened is there really was kind of an uptick in the whole Delta situation with the COVID that really did kind of affect what was going on in the third quarter. Also with some of the things that were going on, both with fiscal and tax policies that were under discussion, the whole debt situation, those things did put a little bit of a hindrance in the market. Plus, we saw that inflation was fairly a big subject, which we'll talk about as we go forward. So overall, it was a solid year to date. It's been a solid 1 year. But the question is, as we go forward, let's look at kind of what's making this up. Now, one thing to note on here, that and the last thing on this slide that I do want to highlight a little bit, is what's going on with the bond side. If you look at the 10-year Treasury, you can see what the rate was a month ago. This is as the end of September, what it was 1 year ago, and really what the rate was at the end of September. So if you look at, for example, at 1.53 compared to a year ago at 0.68, organically, we have seen that rates have increased. Even though the Fed hasn't increased them, we have seen that the market has increased them as far as the valuations on those. Now, what that does do, it does affect bond holdings, and that's something that we always want to be aware of. So when we're looking at equities, we're looking at bonds, two of the big asset classes that we talk about quite a bit. We have to figure out how interest rate changes are going to affect the bond market, especially going forward. So that's something that we do pay very close attention to. So now let's kind of take a look at, we call them the nitty gritty, the basis of what we're looking at from the standpoint of the overall approach, some of the numbers, some of the indicators that help us make decisions to communicate to you what's going on in your portfolio. First of all, there's several slides I have in here that show disclaimers. I'm not going to go through all these and read every index that we're quoting and every background that we're quoting here, but we have to show that to you to make sure that you do understand that I'm not making these numbers up. They actually are coming from someplace. Took a lot of them this time from JP Morgan, a couple other sources that I use. Now, one of the things that we look at on an ongoing basis that we've talked about for years with a lot of the clients that I have is the fact that we talk about the business cycle. One thing that is consistent, and I always tell people, I go back to probably the early 90s in this business, and I decided I wanted to not just be quoting all the axioms that were thrown around in the business, and really focus on what I thought were kind of the educational fundamentals and kind of the fundamentals of what goes on in the business cycle. Because to me, that really indicates how we can dictate our investment asset allocation and philosophy as we go forward. So when we look at that, you can see that we really have the expansion, peak, contraction, and trough. Those are the stages that we go through. Now, one of the things that is consistent, and I don't believe is going to be being erased in the short term or the long term, is the business cycle. And the business cycle is very good. We want a business cycle to happen. If we just had constant expansion, what you would find is that the downturn would be very, very deep. So it is important that we do see where our economy expands, labor costs go up, we start seeing inflation, the Fed cuts rates, we go through that cycle. It slows things down. although we're not employing as many people and we see that start to wane a little bit, it does take pressures off. So the goal of the Fed always, as you hear, is to control inflation right around a 2% range, if they can do that. And that's because they like a constant. I mean, if you could have the ideal world, problem is it's not that exact of a science. So when we're looking at this, those are some of the things that we have to look at. So now we're going to take a look and just do a little bit of an economic update when we talk about what's going on for the fourth quarter and what's going on after that. The road to recovery has been bumpier than we expected, especially in this last quarter that we saw. We had the Delta variant, we had supply chain constraints. Now there are some signs that some of these things are starting to ebb a little bit, starting to go away. But the question is, we really don't know yet what the depth of that's going to be, how quickly we'll see the COVID situation change, how quickly we'll be able to change our supply chain problems that we have, and how are these things going to affect earnings of the company. Because when we look at the things that we're going to talk about, one of the bases that I always want you to remember, two things that we always talk about over the years, that I've talked about for decades basically, is interest rates and earnings. Interest rates are going to give you an indication of where the Fed's policies are. Earnings are going to give you an indication of how a company's doing. Because really a stock in the end is going to perform or not perform according to how well the company's doing. Now we are throwing a lot of different pieces into the situation right now. We're talking about tax law changes. We're talking about maybe changing some environmental requirements. We've seen a transition from producing oil domestically now to looking at more of a international flavor and getting a lot of our supply. I mean, that changes the dynamics for a period of time. How it's all going to turn out, honestly, only time will tell. If anybody sits and is doing what I'm doing and says to you they have an answer, they don't. It's all we can do is take the indicators, take our knowledge and history of what we've seen, and try to look at what the future is going to talk to us about, really interest rates and earnings when you break that down. So let's take a look at some of the factors that we have to look at right now. One thing I want to start with is, first of all, is COVID. When we're looking at COVID, really any assessment that we have of the economic environment has to start with a pandemic. The left-hand chart shows the 7-day moving average of the new confirmed cases and fatalities. These cases and fatalities fell sharply in the spring as the U.S. rolled out its vaccine program, with new cases falling to a daily average of just about 12,000 in late June. Businesses reopened, social distancing restrictions changed, life began to return to normal. Over the summer, however, that pace of vaccination slowed, and we had the Delta variant that caused a resurgence in the pandemic. Now daily confirmed cases rose to over 150,000 in early September, and fatalities unfortunately did rise. So we saw that some of that was climbing to over 2,000 deaths per day. Thankfully, both of these events really have slowed down from what we saw. So it seems that we peaked and now we're starting to see things turn the other way. Now, what is interesting when you're talking about the whole concept, the right-hand side starts talking about the vaccinated and coupling vaccinations with the total number of individuals who have already had the virus. The estimate right now is roughly about 85% of the U.S. population is at least some immunity to the virus. Either they've had it with the built-in immunities that they have, or they've received the vaccinations. This should, and we are seeing it, start to see some of the things start to wane a little bit. But it still is a major albatross on our economic situation as we go forward. So the question is how is this all going to feed into 2022 as we're going into that? We are sitting here now, at October 21st, so 2022 is not far away. So basically the question is what's going to happen with the virus? Now, the good news is we have made progress. We are starting to see that spike that we had change. When you go over here and you start to see that is very much a positive we have. But that is one variable that we do need to pay attention to. I've had a lot of questions, apart from the vaccinations, about the whole fiscal stimulus and our debt and those types of things with the current administration. Again, I leave the political comments to you guys. It's up to you to decide however you want to look at that. I'll just try to state what the facts are and how we may have to interpret those into the managing of your assets. We've had a powerful acceleration for economic recovery has been good because we have put a lot of cash into the system. The 1.9 trillion American Rescue Plan signed into law in March is still working itself through the system and will continue to support the economy through the end of the year. This chart shows the impact of the recession and the fiscal stimulus on the budget. You can see, for example, if you look at, on the right-hand side, our federal net debt, you can see the percentage that we're seeing. We have seen the debt go up. Now, the interesting part when I was looking at this, one of the things that we don't talk about on this slide, but when we had the 1.9 trillion American Rescue Plan, that was not done with raising taxes. I mean, that was not financed by us saying, okay, we're going to spike our taxes to pay for this. Now, what is interesting, the next round of what we're looking at when we start talking about the Build Back Better and the infrastructure plan, that is going to be done with a kind of a balancing act of saying, okay, how are we going to pay for this? Now, there's a lot of debate. You listen to the president, and basically the president says that it's all going to be paid for. Other facets are saying that is not true, that it's not all going to be paid for. I mean, there's going to be somewhere in between. Now, I do know that there's a lot of adjusting of numbers when you look at how long you're putting out the budget. When you say, okay, we're going to add funding of preschool, basically sending the kids to school much earlier. We're going to fund a couple years of vocational type of training. There's cost to that. Now, what happens is what we're seeing now is Congress is playing games with saying, how long are we going to say that we're going to do that? So to make it sound better, we do say, okay, instead of marking it for 10 years, which is kind of the standard, we say, okay, this program's only for 2 years. Now, the problem that I think a lot of us have seen over decades and over our history of our country, many times programs that come into place don't go away. And again, these may be programs that we need. I'm not saying they're bad or good. So when you're looking at the potential cost of infrastructure, childcare, education, these things will be done with increased revenue, hopefully, to help offset some of that. And plus two, in 2017, we did have some tax cuts that the theory was in the Trump administration, by having tax cuts, you would accelerate the economy. So this is important because we are going to have to pay attention to what we're going to do. And remember that the Fed has been very aggressive in supplementing cash to the system. We've seen that the Treasury inflow has been gigantic on a monthly basis. We've seen we kept interest rates very low, and these things will maybe not go on forever if the Fed gets worried about inflation. So these are some things that we have to look at. Another key item is we look at the economic growth and composition of GDP. So when we look at GDP, the long economic expansion, this has been the longest U.S. expansion we had from 2009 to early 2020. Now, that did come to an end with the pandemic. Then we had a recession that followed a very quick recession. We did see that we saw our output fall by more than 10%, which we changed our production. And for anybody that, again, is seeing shelves start to be more empty, anybody that works in more of the situation where you're building things, you'll find that a lot of companies are struggling, whether it be, I've got companies that do roofing, I've got steel, person that works at a steel plant. These types of things are going to be factoring into our inventory. And again, one thing that excited me coming out of the pandemic was inventories were very low. We could build those back. Again, that would build back better as we had to fill the inventories. The problem is that we can't do it because we can't get things out to the shelves. We can't produce things because of either labor shortages or commodity shortages. So that is something that we're curious about. As we move into 2022, the economy should have fully recovered from the pandemic. That's our hope. But with a shortage of workers and some of the maybe less physical and monetary policy, that could change that dynamic a little bit. I mean, the Atlanta Fed just came back and adjusted the third quarter GDP down to 0.5%, which is quite a change from what we were looking at. So we are seeing that these elements are starting to work their way in. Now, the question is, are they, quote, transitory, or are they going to be more directly in it? Unemployment and wages. The surge in GDP has been mirrored by the rebound of our labor market as the economy reopens, and you can see that. after shedding astonishing 22 million jobs between February and April of 2020. The economy has now recovered about 17 million jobs, or 77% of that. That being said, the job market really has not recovered completely. It's still incomplete. We're still running an unemployment rate of about, when I did these slides at the end of September, 5.2%, compared to 3.5% before the pandemic. While this may suggest that some of the labor market slack remains, wages tell a different story. We have seen a big increase in wages. Wage growth has been rising and is at an annualized rates not since the early 80s that we've seen this. So we are seeing that wages are increasing. You put together that surging labor demand, it's just that unemployment shortfall is primary issue of labor supply. Labor supply has been slower to recover. Now, what is the question of why that is? I mean, there's a lot of debate. Is it because some of the programs that we've had to supplement people staying home? Or is it just people are having problems re-entering the workforce? Again, there's some debatable issues depending on which side of the aisle you're talking to. But the key is we do need to see, and it is good that we see unemployment come down, but we do need to see that we're able to staff up more than we currently are. Inflation, the deep economic recession really was mirrored into big declines in the S&P 500 operating earnings. So we did see earnings change dramatically when you look at earnings. So when I talk about earnings, we did see that the earnings of companies did go down dramatically. If you look at some of these bar charts that I have here. Now, the good news is we did see that coming out of 2020 into 2021, that we did see that earnings did recovery. Now, that was really fueled a lot by some of the most important sectors, which were technology, communications sector, healthcare, consumer staples. So those are some of the things that really got hurt during the pandemic, and we saw those earnings come back as we started using more of those products. Going into 2022 and beyond, things we think will be harder. I mean, the earnings are going to be something that you're going to have to look at because there is probably going to be slower economic growth. Higher wages, higher interest rates will probably have a corporate tax increase. Consequently, investors should consider different ways that we can look at valuations and not just look at overall all companies. You really need to take a look, and we're going to talk about that in another slide in a second, of the valuation of companies. Now, inflation is a key issue that we're always talking about. That's really heated up significantly this year as surging consumer demand collided with supply shortages, which really did increase our inflation dramatically. CPI inflation been tracking above 5% year over year since the start of the summer, with the latest year over year gain in CPI at about 5.2. When I did this chart, the year over gain in inflation has been amplified by declines in prices a year ago. So we saw the prices went down. Now we've seen those prices increase dramatically. So with the supply chain issues, we had the semiconductor shortages that we had, which really affected car sales dramatically. These higher input costs have sent inflation higher. So we have seen that there's been a lot more competition for limited goods, which raises the price of things. And plus two, we have seen, and I'll talk a little bit more about the rising labor cost. We have seen labor costs increase. And one of the things I was looking at, really have not seen these labor increases. We're going back to some of the 70s feel to seeing labor increase. And again, I'm not saying it's bad or good. I'm just saying what we're seeing. We are seeing a revival of more of a union negotiated contracts. I was looking at some of, the questions of a lot of the stuff that's stored on the docks. One of the things that the president has been pushing for now is to get the dock workers who didn't want to work 24 hours a day to get staff up for 3 shifts to be able to clear out some of the backlog that we have in the docks. Honestly, the unions weren't excited about doing that. So these are situations where, again, grew up in a union household. My dad worked at General Motors for a long, long, long time. There's positives and negatives to every situation. It's going to be a balancing act, the same as it has been in the past, but it is something that we are dealing a little bit more as we go forward. Now, the question is, with inflation, is it transitory? Is it just due to a short-term recovery out of the pandemic and due to the fact that we have a demand for goods and services over the supply, which drives up prices, and we've seen wages drive up because, again, we as workers are a widget. I mean, I hate to state it that bluntly, we're part of the production process. And you do have labor cost increases because there's a limited number of widgets, us working. So what happens is we have seen that be part of that formula. So inflation is something that we are very concerned about, because if you want to look at one item that the Fed really looks at, it is inflation. So the question is, will this change their viewpoint on how they're looking at interest rates going forward? Since the start of the pandemic, the Fed has provided significant monetary stimulus by cutting the federal funds rate to near zero, by adding substantially to the balance sheet with 120 billion of bond purchases each month, which puts cash out into the system. Now, at the September meeting, the FMOC did deliver a slightly different tone to their message, basically stating that they're looking at probably in November, maybe starting to draw back on that a little bit. And when you look at some of their projections, I mean, again, inflation does worry them. They're not obtuse to that situation. They are looking at it. But they do, the connotation was, they do feel optimistic that growth will help control some of this. Earnings will help control that as we go forward. But it is something that is a lot more evident. Again, business cycle, inflation, interest rates, is not a bad thing. You do want to have it so it's not going up on a straight line, because the fall is much deeper. But it is something as we go forward that we need to monitor what the Fed's policies are, because they will have an effect. And again, all these things are very dynamic. That's why it's tough to have exact answers. So when you look at interest rates and inflation, so what does this really mean for investing? For fixed income investors, there still is a big challenge on trying to get any interest rate, to get any return. The 10-year Treasury, although up a bit, is still not dramatically up. We're looking at a situation where we're still not being paid a lot to be in safe assets. So we're trying to figure out ways to maximize our bond holdings. We're looking at things that, one, will provide us a degree of security from the standpoint of not being in equity. That's one of the reasons you buy bonds. But also to be able to try to get some yields out of these things. And also, if interest rates go up, to have it so your bonds aren't going to be hurt on the downside. So there are areas where we're looking at on the bond side as we go forward. How can we get yields up? How can we gain you interest with money that is going to be more in that secure concept? And that is a challenge. I mean, that is one of the biggest challenges we've had. Now, there are ways that we can look at it. There's things like inflation protected bonds at the rate adjusted for inflation. There's some floating rate stuff. We keep the duration, the length of the bonds relatively short. Alfred and I were talking earlier this morning. High yield has actually still been pretty solid year to date. If we do start to see the economy erode from businesses not doing as well, then you have to worry about high yield. But those are the types of things that we're looking at. When we look at the equity market, we look at valuations. Very simply, one of the things we talk about it all the time is price to earnings ratios. When we look at price to earnings ratios, what are the price that you're paying for a dollar of earnings? When we look at over the last 25 years, you can see that the average is 16.78. You can see currently we're in that 20 range right now as we go forward. So when you're looking at this, it's one of the things that we have to address is, are companies overpriced right now? Are we going to have an adjustment from that standpoint? So that we have to see that you're going to find that maybe companies are going to have to see their prices come down because the earnings aren't justifying the prices. Now, hopefully earnings will come up and maybe justify that you won't have such a high PE ratio. But we're curious to see how that works out with higher inflation, corporate taxes, that we may not see those earnings justify that. Then you may see prices come down on the price to earnings ratio. Also, when you're looking at this, one of the things I'll talk about in just a second is the fact that it's just not going to be a dartboard market where you just pick any stock and it's going to go up. Value versus growth. After multiple years of strong outperformance of growth stocks, really during the pandemic in 2020, growth was the place to be. With declining interest rates and fears about Delta, there's some things that led growth to outperform for much of that summer. This value, we do feel that value still has some room to grow when we look at some of the valuations on some of the value stocks. So it is something when we're looking at it. Also, too, one of the areas that I've been focusing on a little bit more is on the international equity and earnings. try to look at this basically on this chart. We take a look and see that some of the ratios that we look at on price to earnings ratios, on valuations, we take a look and see if there's some places that may provide us some more value as we go forward. When we look at growth patterns, we're looking at some of the developed countries may have some opportunities as we go forward. Europe and Japan, we're seeing some opportunities that may be popping up just because the valuations aren't quite as pricey as some of the things that we've seen. Plus, too, a lot of those places have been behind as far as some of the dealing with some of the COVID situations and some of the vaccinations. So there may be some options that we have there to help our portfolios by looking a little bit more on the international equity side as we go forward. Now, this chart really, this shows kind of finally the last chart I have on the markets here. This slide shows the S&P valuation and kind of dispersion over the last 5 years. What we're looking at right now with the 500 companies, when we look at their valuations, their PE ratios, right now you can see on this chart, there is a big variance here where the valuations of the 500 companies do vary a lot. So the question is what we need to look at, can we look at these valuations and say which companies make the most sense? So when we're investing, you look at where we're at in the business cycle. If things do slow down, if we do have inflation, the Fed comes in and raises interest rates, then you have a tendency to head to more defensive types of stocks. But even if you're doing that, you want to find things from a valuation standpoint that may be on the lower valuation side as we go forward. So right now, the 25-year valuation average has been around 11. So the deviation that we've had there. What you're finding is that that's increased dramatically from what it was. So moral of this story, of this slide, it is a little bit more of a situation where, again, I always call it dartboard market, where you just throw it and you win. With this situation, you have to be a little bit more accurate on where your darts are landing as we go forward. So that is something that we're paying close attention to. And in general, trying to look at the equities that make the most sense at the time, depending on your situation, because everyone has a different risk tolerance. Now, this last one I'm putting up here is basically just to remind you that we have had quite a run, but also too, and I'm going to lead into another discussion here in a second with Alfred, that we do have ups and downs. I mean, if you look at this chart, if you look at from 2000 to 2002, we saw the market go down 49%, the S&P 500, if you use that as a indicator. It took us 45 months to recover. So what I want you to remember, sometimes I'll have clients, they'll come in and say, why aren't we more invested all in equities? They're doing so well. Why don't I want to participate in 20% returns for the last year? Yeah, we do. We really want to, but also too, you have to realize, although there's a lot of numbers and a lot of things that I'm talking about today, this is not a science. It does not, I always tell people, the business cycle does not go like a clock, click, click, click. It'll click forward, it'll click backwards, it'll get stuck. We'll have things that will come in and will stop the clock from running for a while. You have to remember that in investing. And plus, a lot of the people that we're working with are either in retirement or getting close to retirement. And honestly, when we look at 45 months to recover, or we look in 07 to 09, another 37 months to recover on a 57% decrease, you can see here in the S&P 500, those take quite a bit. Now, one of the other things that I'm going to talk about too is I'm going to have Alfred talk a little bit about systematic risk. One of the problems that you have when you have these fluctuations that we've had over the last 25 years here now, we've seen that depending on when you put your money into the markets, it really can change your outcome when we're taking money out in retirement. So it is something that we're very sensitive to. So sometimes, I guess I'm kind of doing a disclaimer here, we'll maximize your return, but that return has to be maximized in accordance with your risk tolerance and your goals. Because what I found over the years, if we take one of these hits, it takes a period of time to come back. And if you're taking money out of your portfolio that you're living off of, you don't have the assets to come back because you sold them. You had to provide the income. So what we want to do is, how can we take a look at that? Now, I know a lot of the stuff I'm talking about here is a little deep, and I know it can be a little dry. And I was kidding Alfred. I think this was Alfred when he was at Shorewood elementary school at one time. But these things can, and this is what we do on a daily basis. So for us, I do get excited about this, which is kind of weird, but it is interesting when you're looking at, because this is a very dynamic time. I mean, I've been doing this since the early 80s and coming out of the 70s, which I remember pretty well. I'm starting to feel a little bit deja vu all over again. I hope that's not the case, because we went in the 80s and had to take some very dramatic steps that Reagan took to really combat where inflation was at that standpoint. But we're always going to focus on the business cycle. We're going to make sure, I mean, again, I'm not negative right now on saying we shouldn't be in equities. I think there's some great opportunities. I think we're going to see that there's enough momentum. We have to stock back shelves, all those types of things that are going to keep us, that we're able to do it. And as long as rates are staying low, but, there's some talk about stagflation. And that really is when, in the 1970s, the economic conditions really characterized by high unemployment, high inflation, where you didn't have much growth going on. So what happened is you had a situation where, if you do have stagflation, that can be something that we have to address too. But so far, we don't think that's going to happen, but it is something that you start looking at historical perspective, and you're just curious with a lot of the stuff that's happening right now, what is going to be the effect on inflation as we go forward. So now I'm going to have Elf talk a little bit about the sequence of returns. So Elf, why don't you take it over?
Yeah. Hi, everyone. Thanks, Brad. Just to introduce myself again, I'm Alfred Hickey. I'm an advisor at Oaktree, and I'm also a CFA, certified financial analyst. And so here I'm going to be talking about, it is related to what Brad was talking in the business cycle, because how your sequence of returns happens. That means what percent your portfolio will get up or down per year can really affect your retirement, especially when you're putting money in or taking money out, beyond just that single number of their portfolio return. So let me load this up, get going. There we go. So your question, you should have in your mind, which most investors do, is how would another drop in the market affect your retirement assets? And also, you have to think about this over a longer term now, because people are living longer. So that's a good thing, but you have to stretch your retirement dollars more. So women do have to consider if they have a longer life. Most people are living longer. And so this increases your risk due to volatility. So before your retirement, we consider this the accumulation phase. And so in this phase, you're putting money into your account. You're working, you're saving, 401k, your IRA, your other accounts. This can grow passively. You want to put this in mostly in the highest growth stocks, so it grows. But then once you start retiring and you want to use that money, you start drawing down, and this makes you more vulnerable to volatility, which means fluctuations in how the market goes up and down, and especially the timing of that volatility, the sequence of returns. So to see why, so how will this affect you? So let's say that you have $1 million and you're going to take out 5% a year, and there is 3.5% inflation, and then various simulated market. And we'll see how, you can see that even with the same returns, if the downturn comes early, it will affect you much more than if it comes later. This is because basically your portfolio didn't have the chance to grow. So as you're taking money out, that hurts the future growth prospects. So you can see it's probably better on this chart. Okay, so here is starting in an up market. So you start at that million, you see at the top of that little diamond over there where it says 27%. So you start out with the up in the market. It goes up 27%, then it goes 9%, then it goes 7%, then it goes down 15%. So after 36 years with that 5% draw, you've drawn down your retirement account. So, that might be okay. That's what your thing says. But if we look at scenario 2, where, now remember, this has the same average return as the last one. but you start out, see at the top of the diamond with a negative 15% return. So this immediately brings down your portfolio, which means that it has less room to grow. So if you're taking money out consistently, you really have to think about this the sequence of returns. Now, in some ways, this is just kind of impossible to deal with because you can't really control, what's happening in the market. So, especially if you're invested in equities, you have to be willing to take the risk of the volatility. But there are some things that you can do. And this is where having a diversified portfolio really becomes important because you won't have that extreme volatility. So here you can just see all the numbers, how it worked out. So you can see it both starts at 1 million, taking out 50,000 a year. And so in scenario 1, you stay all the way to 36 years. And in scenario 2, you only have 23 years. And so basically what happens is everything driving this is just on the first year. So, right? So the first year they get this big bump in the rosy scenario, and then the bad scenario, they get this big knockdown. And this is kind of the other side of compound returns. So, we always say, compound returns are the reason you invest because, over time, they'll get bigger and bigger. But because of compound returns, it's the same reason. So because of that early difference in the up or the down in the first year, that compounds over the future of it. And that's really why this happens. So what can you do to avoid this? Like I said before, the main thing to do is to diversify your retirement. So yeah, this is just showing the two of them coming together. So the things to do to protect you from this. So the first thing, like I said, is to diversify your portfolio. Try to rebalance because then when you rebalance, you're taking away gains that you've made, or you're not taking them away, you're reinvesting those gains you've made because the things that have gone up, you're taking those and moving them to things that have gone down. So you're staying in a balanced risk scenario, and you're also harvesting some of those gains. And similar to that is to have a bucket theory where you think about having different parts of your portfolio. So you have now money, which you should just have, be very safe and be very liquid in a money market fund or something like that you're just ready to spend, if you have an emergency or something. You can also have soon money, which will be more conservative, probably be in more bonds and conservative, small equity thing. And then long money, which will be basically invested for, over 10, 15, 20, 30 years time horizon that you're not going to be worried about if it loses something. And this is also related to diversification because so bonds now. So why do we have bonds in our portfolio now? Given that yields are so low, they're hardly giving you any money. The bonds and cash are very similar. So why not just put everything in the market? Well, the major reason is because of the sequence of returns. So if you have a bond perspective and the market goes down, the bonds are probably going to do all right. They might even go up a little bit if interest rates go down more, and they still have a little room to go down. So then if you're taking out a consistent amount of money every year, you can take that money out of your bonds and leave the equities, the stocks alone, so they can grow, as there's the business cycle. If the business cycle recovers, those stocks will go up, and you don't sell those stocks, so you still earn those, get all those gains, but you just when the market's down, you rely on your bonds for the income. And also a way to take advantage of this is dollar cost averaging, where you just invest a certain amount of money into the market, and then when the market is down, you're actually buying more of the stock. So then you can participate in those gains. And this means you don't have to time the market, but that you put in a consistent amount of time, and then you're not going to get 100% of the gains, but since you can't time it, you're still going to make sure that on average, you're getting the gains. So here you can just see the asset class returns. I think Brad wants to say a little bit about this, but this is also related to this, as you can see that, my diversification point is you're never really sure which is going to be good and which is going to be bad on a given year. So if you have these huge swings, if you're just in one asset class, then you're going to be really vulnerable to bad market time for bad sequence of returns. But more diversified, you're going to have a more consistent return.
Yeah, thanks, Alfred. Yeah, this is a chart that I've used over the years. It's called basically a Callan chart that shows different asset classes. It's been a standard in our industry for quite a while. I always remember one time I was showing this to my daughter, who was taking a kind of a finance class in high school, and she said, so it's basically just buy different colors. Simplistically, yeah, it's true. If you notice, for example, when Alf and I were looking at this morning, we were talking about this, you look at emerging markets, which is a sector that can be very good at various times. But if you look at that purple, the purple is high, the purple is low, the purple is high, the purple is low. That's standard deviation, that's risk. Now, asset allocation, which is you see in white, you can see the deviation isn't as much. So over time, that's why you practice asset allocation. And granted, if we were truly psychic, we would just pick these top assets every year and we'd have a fantastic return. That's not the way it works, because you really don't know. I mean, we don't know when we're interpreting numbers today how it's going to do it. I mean, you just have no idea how some of those things are going to flow. But what a business cycle will tell you, though, is certain assets have a higher probability because of where you're at in the business cycle to perform at a certain level going forward. And that's why you look at this, you try to asset allocate accordingly. It's a very important, relatively simplistic, but important chart when we're looking at investing. And as Alf mentioned, and reason we decided to talk about systematic risk is it is something that as you're getting ready to retire, you're rolling over $1 million IRA or something, and you put that all in, we can have a period of time where maybe things don't go the way they've been going. It's been a great run. We recovered from COVID very quickly. That does not always happen that way. That's why you maybe look at dollar cost averaging. We look at the bucket approach. So even though if something is down, we don't have to sell it. Those are key items that we look at going forward. A little recap here. We're actually at the 45 minutes. Growth will eventually, will growth eventually sputter? That's one of the things we're evaluating. We still think there's opportunity on growth. We just have to be a little bit more selective. We have to solve the worker problem. Jobs are plentiful, but we're just not seeing those being filled. Why is that? Again, there's a lot of thoughts on that. Bottom line is we do need to fill that. It is driving up wages. I use the example of the other day I was lazy. I was driving to work and wanted to get a 12-pack of Diet Coke stocked at the local Quick Trip, which is usually $5.99, which is pretty expensive, for Diet Coke for 12-pack. It was $7.99. I said to the lady, boy, that's quite a price increase. And basically, as I was walking out of the store, I was thinking there's a sign on the front door that said, now offering $14 to $16 starting wage. Now, what happens, I spent some time in lacrosse and remember the Zitzel family who owns, pretty much dominated a lot of lacrosse and owns Quick Trip. They're still going to make money somehow. So how are they going to do that? By raising prices. And that's one of the worries that we have is going forward. And what is that going to do to earnings? Are companies going to just lower their margins to eat some of that? Inflation, how is that going to affect all this? Interest rates, again, the key is watching the Fed. And the last thing I talked about was COVID. We did do a survey and asked people what their biggest fear was in retirement. The survey did say, according to Richard Dawson, I guess, 89% said running out of money was the number one concern. 6% said suffering a drastic change in their lifestyle. And I think that's kind of really combined. I mean, the thing is, you retire with a certain dollar amount that you're living on. Hopefully you're keeping that up with inflation, and you really want to have that lifestyle. And your fear is that going to have to dramatically change? And the last one was, will I have to take another job if these things were really to be dramatic when we saw inflation go through the roof? We did have a 70s feel back to the economy again. Would people then have to go back to work because they couldn't meet it on what the retirement plan was? But that's why in retirement planning, we need to be very cautious to make sure that we're doing that. As we're looking at this, we always tell people that are on the, and I appreciate everyone for listening for this 50 minutes now, that if you know anybody else that would be interested in these types of format that we do on a quarterly basis, or would be interested in the every 2 to 3 week economic update that we put out, feel free to let them know, and we can get them on the distribution list for that. We did have some questions that are there that I want to make a chance to answer. So there were some questions, and Elf, I'll have you help out on some of these also. Let me see. I'm afraid of running out of money. Can you sit down with me and show me different scenarios on how this may work? Yeah, yes, definitely we can. We do have a program that we use that helps us do some planning for you. It really is, it is pretty accurate too. I mean, there's a lot of variables, but it does give us an idea if you're spending this and earning this, and how we put some assumptions into the future, how your retirement may look. And we factor in things you want to do. Do you buy a car every 5 years? Do you take vacations? Those types of things. So always feel free to utilize us on that. Alpha, I'll let you take this one. Is stagflation a threat, like in the Carter years? You did some historical studying for your CFA. What do you think about stagflation?
Yeah, I think it's a little bit of a threat, but I don't think it's a huge threat because I just think that the general inflationary trends in the world economy are much less than they were during that time. So, you know, if you look at the demographics, that was a time where the baby boom all over the world was coming in, and now that's going away somewhat. So, you know, a lot of that was the oil, which we are having some trouble with now, but I think we've already seen that happen kind of in the past decade. There was a big oil spike, and then it came right down once demand died. So I think if demand is to go down, you know, if there was a hit to the economy, which would be the stagflation, which would be the stagnant part of stagflation,
yep,
that would drive down prices as oil would go down and other things, and wages would stop driving. So I don't think that was kind of a unique situation but I think you know, a recession is a worry, and that would not be good.
Yeah.
But
and actually, that was another one of the
specifically,
questions.
yeah, it's stagflation. I'm not super worried about, but both inflation and a recession are things to worry about.
Yeah, and that was one of the questions. Do you think we're headed into a recession? And I think it's a possibility. I mean, I think it's one where we're looking at right now, depending on how some of these things develop. We do have a lot of variables happening at one time. I mean, we have inflation, we have the COVID situation, we have you know, a different political philosophy that we're seeing. Again, good or bad, that's up to you to decide. What happens is, what we are seeing is, it's going to affect what happens. I mean, the bottom line is that when we change our focus on our energy, for example, again, I think we'll all agree that global warming is a factor that we have to look at, but the question is, how quickly do we address it? And how quickly do you go off of fossil fuels and try to get away from that? And what is that going to do to the economy in the short term? So what happens is we see that those areas that we do have to address. So yeah, I mean, we are watching that, but that is the reason that we do say we do asset allocate. I mean, again, that's why we have asset allocation. And again, what we've tried to do is what we call business cycle investing, where at certain times, if we do feel negative on certain things, even though you may score as a 50-50 investor, we may move that down to move you down in that mix on the equity side. Now, the interesting part, as Elf mentioned, probably one of the bigger quandaries, I think we have at least a feel for what equities probably will do in certain scenarios, is the bond side has been tough. I mean, because it just, as Elf mentioned, we park money either short or midterm, so we have money available. It's just tough to get much yield on it right now. We do have some different ideas that we are looking at that do provide some buffering and some protection for that. But those are the questions. I appreciate the questions. Those were very good ones. I'd like to thank everybody for attending, and Elf, thank you for your participation in this.
Yep, my pleasure.
We value your ideas. So if you have ideas, feel free to send those into us, and we'll incorporate them in future webinars and seminars that we have on the economy. So thanks a lot, and everybody have a great day.
Thanks. Bye.